Welcome back to the Wall Street Podcast. Today, we're digging into some critical financial and economic developments. Pulling straight from the latest Wall Street Journal, we're looking at monetary policy, corporate reporting rules, and some shifts in regulation.
That's right. We've got insights from the Federal Reserve's meeting concluding today, September 17th, plus reports from the National Association of Home Builders and the Fed's own industrial production data, both out yesterday.
And also a key WSJ piece on a potential shift in corporate reporting and, well, other articles on geopolitics and trade policy changes.
Yeah, the goal is really to connect the dots. How does a Fed decision link up with, say, unexpected charges on your online shopping? It seems disconnected, but it often isn't.
Okay, let's jump right in. Monetary policy first. All eyes are on the Fed today. A rate cut seems almost baked in, doesn't it? A quarter point.
That's the wide expectation, largely because the job market's shown some real signs of slowing. Payroll gains averaged just $29,000 a month over the summer. That's pretty soft.
But it's not straightforward. You pointed out there's quite a bit of disagreement even among former Fed officials looking at this.
Exactly. So the rate cut itself might be less interesting than Chair Powell's press conference and those quarterly projections, the dot plot. That's where we'll see how unified or not they really are.
What's the split look like?
Well, you have people like former Dallas Fed President Rob Kaplan saying, look, the economy is sluggish, sure, but not falling off the cliff. He thinks the neutral rate might be higher, maybe 3.5%. Caution seems to be his watchword.
Okay, caution from one side.
But then you have others, like former Kansas City Fed President Esther George, arguing, hang on, unemployment is still low at 4.3%. Inflation's above target. Why cut at all?
Right.
And former Boston Fed President Eric Rosengren even flagged that inflation seems to be trending sideways, maybe even slightly up. So yeah, Powell's his tricky communication job today. How he frames the path forward, that's key for markets.
So investors really need to listen between the lines, not just react to the headline cut. Now, contrasting that job market softness, the housing market seems, well, stable at least. The NAHB Wells Fargo index held steady at 32 in September.
It did, same as August. But interestingly, their measure of future sales expectations actually edged up 2 points, hit 45, which is the best reading since March. So underlying optimism there, maybe.
And industrial production, that surprised a bit too, didn't it? Released yesterday.
Yeah, it actually rose 0.1% in August. Analysts were expecting a slight fall. Manufacturing output was up 0.2%, mining up 0.9%. So it's a mixed bag economically. Cooling jobs, steady housing confidence, a little industrial resilience.
Which brings us back to why Powell's guidance is so crucial. Okay, let's pivot. Corporate reporting. The Journal flagged a Trump administration proposal to potentially end mandatory quarterly earnings reports. Shift to semi-annual.
Yes. The idea is to reduce regulation, but it's likely to face pretty stiff resistance from investors.
I can imagine. What are the big risks if they actually did this? Less transparency, obviously, but what else?
Well, it definitely increases what we call information asymmetry. Insiders know more for longer than the market does. That can lead to more volatility, potentially disadvantage smaller investors.
And companies would have to give guidance further out, 6 months instead of 3. That sounds harder to do accurately.
Much harder. It's interesting. In Europe and the UK, they removed mandatory quarterly reporting years ago, 2013, 2014. But many large companies still choose to report quarterly.
Why is that? Competitive pressure?
Partly, yes. And investor demand. ADN, for example, started issuing quarterly updates after some disappointing half-year results back in 2023. So companies that value transparency might just keep doing it anyway.
So it could create a sort of two-tiered system, perhaps. Those who report quarterly and those who don't.
It's possible. It risks undermining the level playing field investors generally want.
Okay, let's turn to geopolitics and trade now. The Wall Street Journal reported Israel launched a ground offensive into Gaza City.
Yes, intensifying the conflict there. Prime Minister Netanyahu described it as targeting Hamas's last important stronghold. There's also a very contentious UN Commission report alleging genocide by Israel, a conclusion Israel strongly rejects as biased. And you have ongoing protests from families of hostages worried for their safety.
It's a deeply troubling situation, and closer to home, on the trade front, there's a change that's directly hitting consumers' wallets, the de minimis exemption.
Right. That rule used to let packages valued under $800 enter the U.S. duty-free. The Trump administration ended that exemption. Now, duties apply to goods from all countries, regardless of that low value.
So if you order something small online from overseas, you might get a surprise bill.
Exactly. From carriers like FedEx or UPS, not just for the tariff itself, but often with added brokerage or processing fees, it makes those small international purchases suddenly much more expensive.
What's the impact been so far, logistically and economically?
It's significant. Costs and complexity for cross-border e-commerce are way up. Logistics firms are scrambling, and consumer behavior is shifting fast. The number of small packages coming into the U.S. daily. It fell from around 4 million last year to about 1 million in May and June.
Wow, that's a huge drop. So people are just buying less from abroad or maybe consolidating orders?
Probably both. Shifting to domestic sellers, or maybe buying higher value items where the tariff is a smaller percentage of the total cost, it's definitely changing the online shopping landscape for imports.
So bringing it all together, Fed policy, corporate transparency debates, trade rule changes, geopolitical events, they really do ripple outwards, don't they? Affecting investment strategy right down to everyday costs.
They absolutely do. It underscores how interconnected everything is and why staying informed across these different areas is so important for navigating, well, the complexities of today's world.
For you, the listener, the key takeaway seems to be vigilance. These shifts aren't just abstract news items, they actively reshape risk and opportunity. The question maybe isn't if the next surprise will come, but from where? Something to think about.